Today, we're going to talk about a theme that is important to take into consideration for some of the longer term opportunities it could create and the risks that may arise as well. That theme is called From Abundance to Scarcity. And the reason that I'm going to talk about it is because it's not necessarily well appreciated in the broader investing community. These are not concepts that have been discussed as much as they should. There are certain corners of the market, particularly in the commodity sector, where there's more research and awareness, and in certain pockets of services that are aware of what is happening, why it's important, these structural changes that have happened. And it really is important to look at all of this from the perspective of long-term trends. These are not things that are going to take place over the next week or month, but over the next several years, possibly even over the next decade or more. These are changes that have happened in the inelasticity of the supply side, which at one point was very elastic. We had a period of time where there was ample labor, both here and abroad, where there were ample resources, where oil and food crops, base metals, everything that we really needed was everywhere we needed it to be, that there was more available than we could use most of the time. And when that changed, there would be measures that could be taken to increase supply, increase exploration and production where appropriate, increase crop yields. But we've pushed and we've reached some limitations. It's harder and harder to get our hands on oil. When we do, there's a lot more restrictions in place as to how and where we can use it. There's also changes in production in that oil discovery has been so much of a lower priority, and so there's less production as well, and production is being slowed as we saw decreases in price year over year, but that production can't come online very quickly. There's a lot of themes here that we're going to talk about in more detail. We're also going to talk about the investment opportunities and, of course, the risks that that environment could create. In essence, what we're looking at is a shift. We went from many decades, really from the late 1980s until 2020, when inflation and supply elasticity were not as big of problems as they've become. We also were lucky that we didn't have the kinds of geopolitical shocks for quite a while that we saw with the Russia-Ukraine conflict that is ongoing. And while the shocks have been to some degree ameliorated there, it does demonstrate the increasing geopolitical risks that we may see as well. So the 5 core components of this presentation are going to be about labor scarcity, capital scarcity, energy scarcity, and metals scarcity. The reason that these areas are important are these are sort of the 5 pillars that are the underlying components of an economy and of a society that is developing or developed. A lack of access to labor, capital, energy, agriculture, or metals is going to impact every economy. And if it is a supply-driven issue, if demand is running up in excess of supply, that definitely creates the potential for not only for there to be higher prices, but also for inflation to become, unfortunately, a more durable theme. That the era of secular disinflation may be behind us, and an era of structural inflation may be ahead of us. Now, as we get into a period of time that may be more of a recession or an economic slowdown, something that may happen later this year in 2023 or sometime next year in 2024, if that plays out, that's likely to relieve some of the increase in price we've seen. That is to say, not only would inflation slow, but we may actually see price decreases within the context of a somewhat meaningful recession. In the absence of that, however, high prices not only become embedded, but the potential for inflation coming back rises. So one of the themes that we're going to talk about over the longer term is why inflation is becoming structurally embedded, how high rates and lower liquidity are actually going to be more routine under that environment. And this is a little bit of a brain melter for people that haven't been introduced to this concept. So hear me out. This is part of the capital scarcity component. But when we talk about The cost of capital going up. Who pays for that? And you're going to begin to imagine all the different parts of society that pay for a higher cost of capital. Now the Fed's raising rates. They're trying to destroy demand. A higher cost of capital certainly does that, but there are some components where they just have to absorb that higher cost of capital and then pass it on, right? So if you're a business and you have low margins, or your investors simply won't tolerate margin compression, you're going to be tempted to pass on that increased cost of capital however you can. Will it be through shrinkflation, where products just shrink and they stay around the same price? Will it be through inflation, where product prices actually rise? Those are things to take into consideration. Of course, some businesses can also slow down production, and that's another structural driver of inflation. If you slow down production and demand comes back, production often can't come back as quickly. So the potential for shorter, more volatile credit cycles and bull markets do come out of this. It is likely to be a higher rate, lower liquidity environment that is often also correlated with higher levels of realized and implied volatility. That can permeate into multiple asset classes, whether it's credit markets, commodities, equities. We've enjoyed a period of very low volatility for a good chunk of 2023. But let's not forget what other times of higher volatility have looked like and what they've been accompanied with. Often higher rates and more scarce capital. So these are themes to take into consideration. As a result of that, and we'll talk much more about this as we get into the later parts of this multi-chapter presentation, but we're looking at legacy industries during credit expansions. As long as this theme is a prevailing narrative, is a driver that we could quantify with economic data, and we see institutions following along, we believe we're in the very early stages of what could be a pretty large-scale opportunity in these so-called legacy or old economy industries. Now, first, we'll talk a little bit about one of the key drivers, and that is labor scarcity. So we know, particularly in the services industry, we've got folks in construction here. That's one area where there is some labor scarcity, that there is not enough people for the jobs that are on offer. If we look at JOLTS, or the job openings from that survey, versus the number of unemployed people who have unemployment insurance, that is a ratio of 1.6 jobs available for basically one person seeking work. Okay? Now, there are some vagaries in the data because we're only talking about, as I mentioned, unemployed insured people. What about when the unemployment insurance runs out? They're not counted in that ratio. What about all the folks sitting on the sidelines, not participating in the labor market? They're also not counted, but we'll talk a little bit more about some of these drivers as we get into labor scarcity. So the labor force participation rate has been falling since the dot-com bust, with each economic slowdown leading to less and less labor force participation. This is a longer-term trend. We'll put the chart on screen later. But this is a longer-term trend, and it's exacerbated by some of the changes that are happening to demographics. Now, we could look at Japan and say, wow, that's a really awful situation where last year about twice as many people died as were born. And it is, objectively. And there's a lot of drivers for that, including, a society that's not homogenized and resists that at every turn. So it's kind of leading itself down that path. The United States doesn't exactly look like that, and I don't think it's heading to that dire of an outcome, but it's not ideal. We're not replenishing our youth. We have an increasingly aged population with about 3 million Americans dying every year. 34% of the population is aged 50 and over, and their numbers are rising quickly. This will be a driver for industries like healthcare over this period of time, of course, as there'll be higher requirements for care. The birth rate is approximately 3 million a year. So we are still growing, but that growth is materially slowing. We're only adding a net population of about 600,000 people a year. That sounds like it's a lot, but in a country of 330 million people, it's a very, very small growth rate. It's like 0.02% net population growth. It's incredibly tiny. And that's not enough. So there needs to be changes that maybe incentivize having more members of one's family or having more immigration policy, generosity for talented labor that can join the services industry and help to ameliorate the shortfall. But right now, immigration only allows in about 1 million people annually. So then you say, okay, so basically net over the course of a year, America's adding about 1.6 million people, newborns plus immigrants. There's about 3 million, dying versus the 3.6 being born. So that's why we're netting that out to 6. And so 1.6 million a year, again, in a country of as many people as we have, is still woefully insufficient. It's still about what, like 0.5%, 0.6%. It's a drop in the bucket, particularly because you have an economy that over time is likely to grow, and you have an increasingly aged population that is likely to leave that economy. So we need to fill the gaps. There'll be ways. And these are things that we'll talk about, but just in a nutshell, of course, I think we can ameliorate some of this with machine learning, automation, robotics. Those will help, but those aren't going to come online as fast as we need. So we need policies in the here and now as well. The investable themes are a little bit further out looking. Those are longer term opportunities. We still need to fill the gap. Now, that's one of the reasons the Fed's doing what they're doing at the time of recording this video. They're probably among their last rate hikes or just did their last hike of the cycle, but they're tightening because they want to slow things down and they want to try to reduce that gap in the labor market and get some more people off the bench, as so many 55 and over retired at the start of COVID. Now, here's that labor force participation rate chart that I had promised, and we can see the dot-com bust with the second shaded gray area, right? That's where it started. That was peak labor force participation. And then the great financial crisis, and boy, it fell there and thereafter, just like it fell after the recession from the dot-com bust. You can see it continuing to fall until about 2004. After the great financial crisis, it continued to fall until 2014. And then we had that pop into the Fed beginning to kind of ease a little bit more, or at least take their foot off the brakes in 2019, and then COVID happened. And the labor force participation rate, it's recovered, but not completely. And even if it does recover to pre-COVID levels, you still have very low levels of labor force participation. And again, there are demographic issues at play. You have 55 and over dropping out of the workforce appreciably. Younger people are working more. Their labor force participation has actually risen, but it's not enough to make up for it. And we can see it in the chart. 23 years of declining participation. U.S. annual population growth is at the slowest levels that we can see on this chart. Now, it's probably slightly better this year, but not enough. And that's the concern, isn't it? That this is exactly what we're talking about with the birth rate versus the death rate, with immigration, with the changing age components of the U.S. population. You simply don't have enough people, particularly of the age that need to be working, right? Between let's call it 18 and 70. I know that's a pretty big range, but that's pretty much the prime target group until America lets their people enjoy the tax benefits of their retirement. And then you could say, well, at the very least, you've got to have a lot more people from 18 to 50 in the mix. And yet the younger contingency of that group, they're becoming more, participation is rising from those groups. So they're adding jobs for them. Those folks of those age are taking those jobs. And so that labor force participation for that particular demographic is going well. But on the other side of it, you have people of older age that are dropping out because of the wealth effects of monetary policy that have driven their retirement accounts to very high levels, appreciably higher than they were before COVID. And so they're sitting comfortable and don't feel like they have to really work anymore. And Powell spoke a little bit to this, but hasn't done much to address it, or at least the policy changes that have happened haven't brought about a real restrictive monetary policy regime such that the price of assets moves lower, such that it motivates people to come out of retirement. Now, we aren't alone. We do see similar trends. I did talk about Japan. Japan is much worse. Europe is kind of like the United States, maybe a decade or two forward in the population trends in the more sort of developed parts of Europe, if you will. But nevertheless, these are trends that are happening in a lot of countries. We're actually expecting to see some of that occur in even some of the faster growing countries in the decades ahead. But in the here and now, this presents a unique set of challenges, particularly for the services industry. It's why companies have been reticent to let go of employees. It's also why there's been more strikes, because people have more bargaining power than they've had in a long time. They are now able to come to the table and say, I want a higher wage, I want better benefits. If you're not able to give that to me, I will move to another job. Recently, 76% of people surveyed said they would leave their job if they didn't give them flexible work. And I think that's a trend. I don't think it's something that everyone in every industry can enjoy, but I think it is a trend. And I think all the strikes we're seeing, which are the highest level in decades, are saying that as well. And then renegotiations of union contracts, wages continuing to rise, now actually starting to rise in real terms, which could actually help American families. But it does put upward pressure in a structural way on inflation. And so does the drop in the number of children that families are having. And this is an issue because now it's translating to the numbers. The overall United States under 18% change from 2010 to 2020 was down 1.4%, right? That was led by the Northeast, but the Midwest and the West were participating in that drop as well, with only the South adding 2.1% to that age range. Meanwhile, 18 and over grew in all categories, but we need to see younger people. We need to have replenishment of the workforce and population over time. And those trends probably have deteriorated since COVID. We also see population distribution. There's a lot more older people, and so they make up really a large chunk of the population. Look at 65 plus at 57.8 million Americans, 55 to 64 at 42.1 million, 45 to 54 at 40 million. And you can take all the other age ranges combined, and you're going to see that it's not a materially different number. That's a problem. We have an imbalance in the distribution of ages, which is going to exacerbate some of these labor force issues that we're seeing. And parents aren't really procreating. We talked about the low rates of under 18 growth in everywhere but the South. In fact, everywhere else it was negative. The South had an appreciably low rate. So the majority of childless adults say that the reason they probably won't have kids is they just don't want to. Medical reasons, financial reasons, no partner, age were the leading causes cited. And the share of non-parents younger than 50 who say they are not likely to have children is up to 23% from 21% in 2018. We also have parents from 18 to 49 saying they will not have more children, rising to 54% from 51% in 2018. Age, medical reasons, we talked about this a little bit, are some of the top reasons parents don't expect to have more kids. So the people that have had kids aren't likely to have more kids. The folks that haven't had kids are increasingly not likely to have any kids. That's not the trend that we want to see. The next theme that we're going to talk about in the video that will follow will be energy scarcity and why that is important for the world economy, the U.S. economy, and what opportunities that will create in the future will be a theme we'll follow on later.